Well, good day to all of you. I hope you're enjoying how things are going so far. I certainly am having more fun with Blackboard than I thought would be possible. Hang in there, though. I know Virtual Campus is doing whatever they can to try to resolve some of the issues. But let's go to something simple today. Let's look at accounting. Now, with this accounting review for your course, I don't expect any of you to become an accountant. In fact, I'm not sure I'd wish that on any of you, but we're going to take a look at the three main statements for accountants. These three statements are what provide the picture of a business. And with that picture, the financial manager is then able to evaluate, analyze, strategize to determine where the business has been, where it is now, and how it might be able to get to where it needs to go. So, for the accounting review, the first thing we're going to look at is our income statement, because this is the one that gives us profitability. The income statement's main purpose is to determine the profitability of the firm. The balance sheet is a statement of assets and liabilities. And the statement of cash flow, well, cash flow, folks, is the lifeblood of any business. Without cash flow, cash coming in, cash going out, this business is going to fail. After all, have you ever tried to make payroll without any cash available? You got to have the cash coming in order to send it out to your valuable employees. So let's start with the income statement. Now you can follow along on the PowerPoint, which is what I'm going to use as the guide. And hopefully, as we work the PowerPoint and work this video, we'll be able to get a little better understanding of how the accounting picture is presented. So here's our accounting statement, and we start off with sales. Sales, of course, are the goods and services that are provided by the firm. And from sales, we subtract the cost of goods sold, giving us gross profit. Now, gross profit for many businesses, especially retail businesses, if you work the percentage here, that gross profit is really pretty impressive. Most clothing stores will sell $100 worth of goods that may have cost them $25, giving a gross profit of 75%. And you'll say, wow, 75% profit? We're doing great. But wait, there are other costs you've got to subtract. The next thing after gross profit, we're going to subtract selling and admin costs. Selling and admin, as described in, well, if you can look at what it's for, advertising, rent, employee salaries and wages, fuel for your truck, the kind of things that it just costs you to do the business. And we're also allowed to subtract depreciation and depreciation is the expenditure of the value of the assets of the firm. Take that delivery truck. Every mile you drive really costs you about 75 cents of value on that truck in depreciation. So depreciation is an attempt to try to measure the expenditure of value of your assets. It's all driven by the tax codes. And when we get depreciation and selling and admin taken off the gross profit, we have what is called operating profit. Operating profit is known by many other names, but it's still operating profit. This is the amount that the firm has remaining to take care of its external obligations to other businesses, such as, well, that good old federal government and the state government that we deal with. Operating profit is also known as EBIT. or earnings before interest and taxes. So, we've gotten down to operating profit. Let's see what comes next. Well, we're going to have to start paying these bankers and the government. So from EBIT, the next thing we do is we subtract interest. Interest, of course, is your financing cost, the cost of getting the loans from the banks or the bondholders. And so we got to pay some interest. And this gives us EBT, or earnings before taxes. And then Uncle Sam and Uncle Harry, the state guy, they come in and we start paying our taxes, giving us what we call net profit. Net profit can be called many things. It can be called net income. It can be called net profit. It can be called just plain old profit, if you want to be very short about it. But it's also earnings after taxes, and it is essentially the bottom line for the firm. This bottom line is what the firm has accomplished by taking care of selling its goods and services, subtracting all its costs. That's what's left. That's the result. Putting it in economics terms, that's a measure of the opportunity cost of doing business. And, you know, you can have a profitable firm, accounting-wise, but if that net profit isn't enough to satisfy those doing the business that makes it worth it, that's the is it worth it value right there. If it ain't worth it, this business is probably going to shift itself around. It needs to make that net profit worth it. It can do it by trying to adjust taxes. It can do it by trying to adjust interest. It can do it by trying to adjust its selling and admin expense, or finding lower price suppliers for its costs of goods sold in order to try to make that worthwhile. Of course, there are many different ways to adjust these various costs, you know, like interest, taxes especially. Don't do like this one fellow I know up in Amarillo decided he wanted to reduce his taxes, and the government didn't like his method, so he spent 1.5 years in the federal penitentiary reflecting on his choice of methodology. After we get to the bottom line, after we get to our earnings after taxes, we need to distribute that net profit to the owners of the firm. So, net profit, or EAT, is then distributed. First, we're going to have to pay our preferred stockholder dividends. They get paid first, preferred stockholders. And then that gives us what is called earn, or that is the profit available to common stockholders. Okay? Common stockholders. That's just available. But from the earnings, many businesses will retain some of their profit in order to help finance the firm. That's called retained earnings. And retained earnings remain something that common stockholders deserve, yet the dividend policy of the company will be such that we're going to say to the common stockholders, we're asking you to invest some of your profits back in the firm so you can help improve the overall financial situation of the firm. And that gives us, after we subtract that, the dividend that can be provided to the common shareholders. That dividend, of course, as shown in your PowerPoint, is distributed on a per share basis. So we take our dividend, dividends to common, we divide that by the total number of shares. And total number of shares is also called shares outstanding. From this, we also get the price to earnings ratio, which is one of those key measures. And I recall, I think I sent a document to you that discusses, one of the debates about the PE ratio. So the price to earnings ratio is simply the share price divided by the earnings per share. And earnings per share, we have to leap back a little bit. The earnings per share then is simply the earnings available to common without regard to the retained earnings. So we go back and use earn for the earnings per share. Okay, and that's shown in your slides. I hope you enjoy this quick picture of the income statement and some of its initial uses. I'm going to chop this video now, give you the income statement, and then we're going to look at balance sheet and cash flow in a separate little video. Thanks.